Welcome, Cameron. The name of your business, please.
East West Insurance Brokers.
And how long have you been in broking and with East West?
I've been with East West coming up on 5 years. I've been broking since 2001, which is 20 years.
Yeah.
And I started in insurance when I was 17. And that's 35 years ago.
Okay.
So, yeah.
Family and others, or are
Well,
they
you'll get to
part
see.
of the
Oh,
side
well,
team?
no, I have a lovely second wife,
Yeah.
Hayley.
Does your first wife know?
Yeah.
You're not still married to the first one?
No, I'm not a bigamist. If I had two wives at once, I mean, it'd be a bit hard to call one of them second. You know what I mean? That might upset the apple cart.
Anyway.
Mila, who is a year old. I have a son who's 25, Riley, and a daughter, Erin, who's just turned 19.
Lovely. I want to have an ask for a while. What was your very first job and what did you get paid for it?
Actually, my first job was actually as an unclassified superannuation clerk at Suncorp, and my fortnightly income was $277 gross, which even then wasn't a lot. So, humble beginnings.
Yeah.
And, I've gone on to this sort of very humble future.
Take it away.
All right. This is the moment everyone's been waiting for.
The eyes. Oh gosh, it's adorable.
So, yeah, that's obviously Hayley, myself, and Mila there. The Sasquatch there is Riley, Erin, and Mila. And there's 3 pictures of Mila and only one of everyone else, and I've already told the other kids, look, there's a new favourite. Okay? And then if they complain about that, I just say, well, who's your favourite? Because Mila's everyone's favourite. How can you compete with that? She'll probably grow up to be a rat bag and then we'll be even again, but just for the moment.
Yeah.
Exactly. Okay, now I'm rehashing a topic that I've done before, but I think insurance has a tendency just to be so mind-bogglingly, bafflingly confusing that the thing that makes it simpler is just to go back and understand the fundamentals of it. And it's amazing. This is a bit of a staff training piece I do, so that staff, when they're in the middle looking at some unfamiliar policy, it makes no sense to them. They can sort of locate themselves in the basics and then understand it. So, I'll probably stuff it up, but we'll see how we go. This is general advice only. Okay? You need personal advice, you need to talk to someone. So, I just like to overview what I'm going to talk about. This is obviously all to do with insurance. Start with the conditions, the fundamental conditions of any insurance contract, the categories of insurance, classes of insurance, exclusions, how they're packaged, a couple of final truths as a final message, and then some questions. So there's 3 conditions and obligations that with every contract of insurance, it has to be an unforeseen event. So it can't be that you were waiting for your air conditioner to break down and, it's got to be an unforeseen event. You have to have exercised some due care. So you've got to lock your car. And you have to comply with the law. So if you're practicing as a solicitor without the right license, you're not going to be insured. So, simple so far?
Except for the locking the car. That's next big one.
Yeah, actually, on that, what happens if you just happen to forget on one occasion? Does that mean all of a sudden insurance policies?
No, they will actually cover you.
Okay.
If you leave the keys out, like if it's something where it's like a habit that So you, like, don't leave your keys on
Take them to the driver's side window.
Exactly. Don't leave your keys in the car.
Do you know it's illegal to leave the car on the door? Because normally we used to do
Good question.
Yeah.
Yeah.
That happened to me recently. Where it's like I left the car unlocked at night time. Came out the next morning. Someone had obviously been through my car. Luckily, they didn't take it up to the grave. And I was like, phew. But yeah, I thought, oh my gosh, what if I'm not covered for that? When I just completely forgot that, like baby brain.
Yeah, well, look, most policies would actually cover you for that because it's like a human error. But if there was any sort of indication that you regularly left your keys in the car or, that sort of thing.
I made a claim for it before.
Yeah, that's right. So, yeah. I mean, obviously, due care is probably more relevant, let's say, to you have allowed your gutters to completely fill with leaves. There's a tree growing out, like our neighbours have. and all of a sudden your ceiling is inundated with water. Well, they'd say, well, you haven't really taken any due care to avoid that situation. It's pretty obvious that you can't show any evidence that you've had the roof looked at, and and that'll put you outside insurance territory. So there are actually 5 categories of insurance. There's own damage or your own costs. So that is, I own something and it has been damaged, and because I own it, I want to insure it and get paid for it. There's legal liability, which means I've done something silly. It's caused someone else some sort of damage or injured their person or their property. There's consequential loss, which means, hey, if I only had my car, I'd actually be able to keep working as a courier. But since I don't have the car, well, I've lost this much income every day, or loss of revenue is the typical thing of consequential loss. Now these other 2 are a little bit more unusual. There's mitigation costs or prevention costs. Now normally you'd think, well, insurance shouldn't necessarily pay for me to avoid a loss, but sometimes it does. So the good example is product recall. So I've produced a product and it's gone out to market, but then we've discovered in our batch testing that actually there's a fault with that product. Now, it hasn't hurt anyone, it hasn't caused any issue, but we've got to get it all back. That's a mitigation expense. It's not a legal liability because no one sued me yet, but I'm going to have some costs to avoid that. You can insure for that sort of thing. And the final one is the weird one of the group. It's called parametric, and that means the insurer pays you a set amount if something happens. There's a defined event, but it's not, what they pay you is unrelated to how much damage you suffer. So hail cover these days for car yards is normally parametric, where if hailstones of a particular size fall and they're detected, they just pay out whatever the face value is. But another interesting one is a policy called prize indemnity. And I've organised prize indemnity. It was like a big tray of fruits, and the contestant had to grab a fruit and see if that was the $1 million fruit. Now, if you've got a lazy, 20 grand, you could probably have a tray of, 30 fruits and say, hey, pick the right one, you get 20 grand. You might have a few people interested. But if you make it 100 fruits and it's $1 million, all of a sudden everyone wants to play. A lot of those...
All in ones at corporate days. They're all insured.
Yeah. So basically, instead of saying...
They're on there with a video camera. They're usually paid by the insurance company to provide proof. Yep,
exactly right. So it's a lot more... Basically, whatever prize you thought you were going to offer, you pay that to the insurer as an insurance premium, and they'll, multiply it by 10 or 8 or whatever the function is. But then they'll supervise it. It's really good because a lot of the time the insurer will then provide all the expertise to run the contest for you. So there's a bit of a service piece there as well. So that's parametric, fixed payout on a specific event. Now you would think, okay, the most policies that I could possibly need is 5. I'll just list up all my assets and I'll get an own damage policy for all that. I'll list all my activities and I'll have legal liability for that, and so on. But something comes along that sort of changes that. There's not a maximum of 5 policies, because then you've got insurers have different appetites for risk and different expertise. So, you know, the human mind, you might have one underwriter that understands all about professional risk but doesn't understand about physical risk. So as soon as you bring that appetite in, it's not that complicated. You just end up with a few classes of insurance that develop out of that, and so it's all pretty simple, really. So that's at least 46. That's just off the top of my head. And there's others.
What's the most common one you do? Public liability? Cyber?
The universal coverage for business is public liability. Every business has a public liability risk, no matter what you do. Just think, okay, well, I'm an accountant. I sit in an office, and how am I going to injure someone? Well, if you go and visit a farmer to talk to them about their accounts, and you leave his gate open and his prize bull walks out on the road, well, there's a public liability risk. Or if you just happen to leave your umbrella in the wrong. It's also a universal risk for every person on the planet. Every home insurance policy has a public liability coverage. Have people over for a barbecue, someone has a few too many trips up your stairs and, you know, loses some teeth, well, they can sue you. They'll say, hang on a minute, you allowed me to get very, very drunk at your house and these treads are not quite right, and your home insurance protects you. It really is part of standing between that litigation and the asset of your home. There's a liability policy there.
The event cancellation, were there like pandemic clauses in existing event cancellation policies that prevented them from paying out? I imagine
I'm going to talk
forward-thinking lawyers would have got in there and thought, what can really hurt us here?
I'm going to talk about exclusions in a moment.
Sorry.
No. No. It's good question. I'll put a pin in it and we'll get to it.
Oh, the jargon.
So once you've got all those classes, and so you've gone from conditions to the sort of categories where an insurance policy is going to fit, the classes that then generates, and then you've got exclusions, and there's really only 3 types. There's activity-specific exclusions, which really reinforce disclosures. And a good example would be if there's an accountant's professional indemnity policy, it's probably going to say you're excluded from providing financial planning advice. Because what they're really saying is, well, if you're going to do financial planning, you need to tell us about that. So it's probably just, well, it's to more sharply define the insured activity, rather than just relying on what's written on the application form, which can be all free text and all over the place. They say, okay, well, thanks. It's really a way of the insurer saying, this is what we understand that you do, and just to make sure we're all on the same page, all these other things, they're not going to be covered. Then there's cover specific. So that's to define the policy type. So, for example, they want to make sure that property coverage doesn't leak into a professional indemnity policy. So a really common exclusion is failure to insure. So if for some reason it was your job to organise insurance and you don't do it, then you're not going to be covered for that professional risk, because that's really allowing property risk to get into the professional indemnity pool, which the investors on the other side won't really like. Because when you lay your money down to invest in professional indemnity risk, you don't want to find that there's some property risk leaking in through the back door. So that's another reason for an exclusion.
Does that come about from some genius who realises that they only need one cover and that they can claim under this cover by not having that cover, and then they close the loop?
A lot of it just develops over time. I mean, it's, you know, with contract law, litigation, it's a game of cat and mouse. Someone succeeds and all the insurers run around and fix it. Product evolution is driven by this. If you're an IT provider the only policy you can get is actually a combined professional indemnity, public liability and product liability policy. And, that's all sold as a great little package benefit. But the real reason is that at law, if you don't have one of those policies, you can usually reframe your litigation to hit one of the other ones. Because what's the difference between IT advice and IT product when you're developing software? Is it a product? Is it advice? Is it either? It could be both. But if you know what insurance your defendant has, then you'll make your argument accordingly. So insurers had enough of this and said, well, from now on, we're not selling one without the other. Here's your package. And then it's now sold as a great benefit, but that's the real reason. The other reason is it's an uneconomic risk. So perfect example is flood. Because the frequency is too high, it's uneconomical to offer the cover. And a good example, I'm going to say that an excess is really like a frequency exclusion. That's what they're saying. It's not economical for us to manage claims under $1,000. We'd have to open files. We'd have to do all this extra work. We've got to thin the herd a bit to make this proposition economical, not just for the insurer, but also for the insured, because the extra premium sometimes to have an insurer manage a $1 claim when it's costing them, $100 to even have someone sitting in the seat to look at it. And the other one is severity. So what they're saying with pandemic cover is that the maximum severity, as according to our models, is too much. We can't act. A good case in point is the global insurance industry was technically insolvent immediately following the World Trade Center. There was actually more contingent liabilities to be paid than there was actually insurance pools. And that's when all the Lloyd's names were asked for contributions. They did capital raisings, all this money needed to be found to cover those risks. And meanwhile, they were busy trying to trim them as much as they could, had their brightest minds on how we could reduce what we actually have to pay out. You can argue whether that's right or wrong, but that's just what they did. And, the reason why pandemics were excluded is because a global pandemic is more than the insurance industry worldwide could handle. Some of those exclusions, because they were pretty universal, but some of them weren't drafted particularly well, and there may still be some claims related to pandemic on consequential loss, just because of drafting errors, not because the intention wasn't there to avoid the claim. And a good example of an indemnity limit exclusion is a severity exclusion is the indemnity limit on the policy. And saying, hey, we're going to give you $20 million liability cover. So yeah, it could be a $40 million claim, but we're putting a limit. We can't go over that. That's effectively an exclusion. Now, a lot of people wouldn't see it that way, but I think that's a good way to look at it. And there is one more exclusion type, and it's very, very important. That's the dodgy one. Now, if you look at your policy and there is some activity exclusion and it directly encroaches on what you actually do, that's dodgy. Insurers, they might claim it's an accident, but some of the times they do it on purpose. Only in the last 2 weeks, I put up a product, basically a product manufacturer's risk. And one of the insurers responded with these red hot price terms with a product liability exclusion. Well, what's the point of that policy? Why even respond? Another one I had, this guy was building jetties actually, but we disclosed that he used a lot of contractors, and one insurer responds with a policy that has a blanket contractor injury exclusion. So yeah, you do actually have to be on the lookout. It's not that exclusions are there to be dodgy though. Fundamentally they serve a purpose, and if they define your risk and do all those things that I mentioned, they're great because they make it an economic proposition. But you will get especially at the coal face. You'll get someone who's a bit under the pump for budget. I really want to get this policy. I could probably write it if I throw this in. Oh, well, And it's kind of up to clients, but also brokers to review these things and ferret them out. And they're always full of surprises. Now we get to packaging. So all those 46 plus classes of insurance are often packaged together. And these are common package names, but a business insurance policy, there's no class business insurance. It's not actually an insurance class. It's a multi-section policy. It could be different from insurer to insurer. The typical sections, there's public liability, property damage, theft, glass, all sorts of things can be thrown in there. But you're not really going to learn anything by knowing someone has a business insurance policy. You've got to see through that package to what classes are in there. So now that I've confused everyone, I'll just give you some truths that will help practically with understanding insurance. The first one is, and they're a bit brutal, if you own it, it's your responsibility to insure it. So yeah, I've given my package to a courier. Oh, but surely, if something happens, no, they're not going to replace it. I mean, they have a liability policy, but not everything's going to be their fault. If you own something, you insure it, no matter what. If you leave it in a storage shed, that's another classic. People think, I've left it at, national storage. I tell you what, those guys better look after my stuff. Well, they don't. No, if it's damaged, you've got to buy it. And if you do have any recourse on them, it could be months away, years away.
Sorry, those, when you look at clients on Qantas or whatever, and they say, would you like to protect your baggage or whatever? What's the deal there? Do you need that insurance? It seems like it's got about a 75,000% markup on it to buy a single trip insurance for $20 or whatever it costs.
So they put the insured bags in one section of the plane to make sure they take extra good care of them.
So without the cover, they'll be legally liable if they do something wrong, if they breach their duty of care. They can't contract out a duty of care over your bags. But again,
if the plane gets shot out of the sky, it's not their fault, basically.
And also the other thing is under transport.
You went down with the bags, presumably.
But if your bags, but if your bag turns up, 4 months after you lost it, and they've contracted out of their consequential costs, they actually might have no liability. But you haven't had your bags for 4 months. The reason for the big markup is convenience. There's other ways to access that sort of cover. It's essentially saying, here is a property damage cover for your bags. You can buy it now. It's very convenient, and it's marked up for the convenience. Or you could just have a travel insurance policy and it's included. But a lot of what you find is a lot of the biggest markup is around convenience.
And also, a lot of credit cards say, oh, we offer travel insurance as a credit card holder. Is that worth the paper it's written on?
I'm going to say it is. As a free cover, it's worth that.
It's better than nothing.
Yeah, and some of the...
Would you fly overseas and think, oh, it's okay, I've got
No, you'd be mad if you did that. You'd be mad if you did. I've written a LinkedIn. I wrote an article on LinkedIn about free travel insurance. I'll send it to you. And I made it a little bit amusing because the thing is that, your average Australian, it could be a mild-mannered, financial planner like Adam, for example. And as soon as they're in the sky and they go over into international waters, they turn into Bazza McKenzie. They start sucking down tubes of Fosters and become completely out of control. This is your typical Australian tourist.
He goes to Bali. No.
The traveller, the Aussie traveller, they're notoriously bad behaved, And but all of those credit card covers have an alcohol exclusion, and it's very, very broad and very sort of fuzzy. They have pre-existing illness exclusions, so that could be when I was playing firsts in year 12, I just had a bit of a twinge with my knee, and there's some medical record. Yeah, if there's some kind of record there and your knee blows out while you're over there, I mean, that's the sort of thing the credit card company is going to say, hey, sorry, pre-existing condition, you're on your own. Now, a lot of the times they're a bit less severe than that because they don't need to be on the front page of the Australian, but the ball's all in their court. You're at the mercy of their largesse. The second truth is if you act, you can make a mistake affecting others. If you drive a car, you can have an accident. There's no way, oh, no, I'm really, really careful. No. If anything happens, it'll be someone. Oh, you hear this all the time. So just stop kidding yourself. If you undertake any activity, you could affect someone else with your actions. Walking down the street, you could be on your phone and you run into someone. That's a public liability claim, potentially. And the other truth is you cannot rely on anyone else's insurance, ever, no matter what. So you get people who say, I'm exhibiting at the convention centre. They'll have liability insurance, won't they? Yes, and it'll cover them. It's not going to cover you. So if there is something that goes wrong and they're hit with a litigation, well, they'll have their insurers appoint a lawyer and defend it all, but they're not going to. Their lawyers aren't going to act on your behalf, and their insurer isn't going to pay any of your claim. Now, you can get extensions to include contractors and other people. That's quite a deliberate situation, and effectively that doesn't mean it's someone else's insurance. It means you're sharing it. It's your insurance. It's just maybe bought as a package or you're extended onto it, but it's not. You're not relying on someone else's insurance. Someone else may be organising it for you. Like when you tick the box on the travel thing, that's your insurance. So you just allowed someone else to organise it for you for convenience. It's not like Qantas, you're participating in their insurance. And that's the three truths. And that's my advice to make all this work is just start with a risk assessment. Whether you do it yourself, but we do one, and that's the little QR code you can scan. It's on my business card, but it's just the best place to start is to say, okay, I would like a list of all the risks and what are those classes that are relevant to me. Of all those 46 more plus classes, which are the 8 or 9 that I need to be thinking about? And when you've got that list, at least then you can sort of get started. And that is it. Questions? We've had a few questions. What's that?
Well, I think you're like, I'm just thinking, I'm sitting there with client A and B, and they're talking about their business. I don't know about the insurance, I can pull out your business card and say, scan this. Just submit that, and my guy will get on to you.
Here's one I prepared earlier.
Thank you.
Sorry. I was doing that for dramatic effect, but it didn't quite work. So, anything else that came up? How did I go for time? I just
Very
interested.
good.
Very good.
Yeah.
Okay.
It was a concern.
What's that?
You are predisposed.
Hey, I've rehearsed this.
Yeah, nice.
I had a little timer out.
Oh, wow. That's really good.
Make sure that I didn't go over because I thought,
That's
oh.
very good.
I do have a question based on my answer to this meeting
Oh, yeah.
about run-out insurance. The client
Runoff, yes.
Runoff, not out.
No, that's all right.
When
Yeah.
you run out,
Yeah.
the policy ends. So they sold the business a year ago, and they have the runoff insurance for another 5 years.
Mm-hmm.
But is there something that they can change the providers now, or are they stuck with
So
the same thing?
now runoff is the common term, but I actually prefer the to call it extended reporting period cover, because even that actually describes it better. You're actually saying, well, look, my business has stopped and I don't have any future work, but what I want to do is extend the time I have to report a claim and have it covered.
Yep.
So, a bit nitpicky. Well, there's no reason why there shouldn't be, but practically there's no secondary market for runoff or cover. There used to be. There was actually an insurer called St Paul's Travellers, which used to do the Law Society's insurance before they pulled out of Australia, I think in 99 or something. And they actually used to run around and pinch other insurers' runoff cover. So the insurer would say, hey, we want to charge you X for 5-year runoff, and you could chuck that on the fax, because that's how long ago it was. You'd put that runoff quote from the current insurer on the fax to St Paul's, and they'd knock 10-20% off it. Wonder why they kind of pulled out of the Australia. I wonder why they had trouble in Australia and pulled out, because they weren't making any money. Because that's pretty, aggressive way to do things. So practically could happen again, but at the moment, as far as I'm aware, and this is only as far as I'm aware, there's no secondary markets for runoff. You're stuck with the insurer. It's why I put a lot of thought into not just who the brand is, but which insurers are backing up that policy. A couple of years ago, we actually had some problems placing runoff for architects with a particular underwriting agency. I think they changed their security insurers about 3 times in 4 years. We ended up getting it sorted, but we started making different decisions about where we placed. Because, how do you tell a 65-year-old architect who wants to retire, oh, sorry, your current insurer doesn't want to give you any runoff cover, and there's no secondary market? So sometimes it's a bit of a long game to try and make sure you don't get yourself painted into that corner, so you avoid tiny underwriting agencies you don't know much about.
Who are the reinsurers?
Lloyd's.
Is it just Lloyd's and Berkshire essentially, or
for whom?
Look, so who's liable? Who's got the big bags of cash in the background where the buck stops?
Do you mean in terms of professional indemnity?
Or are there lots of them in the background? Because I know with life there's like 2.
No.
There's like Daiichi and someone else, and that's it.
So you're saying there's a bit of a convergence at the top?
Yeah.
Yeah. Well, you've got...
Because it requires a lot of...
Yeah. So, really, you can run around the countries. You've got Allianz is German, Zurich is Swiss. You've got Berkshire Hathaway is American, AIG, Chubb. You've got QBE, which is Australian, but globally they're huge. You've got IAG, which is CGU and all their myriad of, things. You've got Suncorp. They're a significant Australian insurer.
Suncorp, for example, though, we always get told after a weather event, our liability is capped, we've reinsured it. Who do they go to? Who's Suncorp? Oh,
there's Swiss Re, there's Munich Re, there's all sorts of reinsurers. But obviously a lot of it ends up in the Lloyd's market. So Lloyd's is not an insurer, it's a market. And it's full of syndicates, and those have paid a syndication fee. And by being part of Lloyd's, they also get to access those prudential sort of protection. So there's extra layers of protection in the Lloyd's market. If you're part of that market and you follow the rules and your book is overrun, you can claim on a central pool of funds to help you as an insurer through that.
The central pool of funds comes from private investors using it as a corporate bond of sorts.
Yep. It's called the Lloyd's names. Lloyd's, being a Lloyd's name, it makes you a lot of money until it doesn't.
Yeah.
Because there's if the Lloyd's market is overrun, Lloyd's can issue a call on the names, and those names have to respond with more money into the system. So that's the final layer of disaster protection as they go around to Lady and Lord Fauntleroy, whoever they are, and they say, hey, you might have to sell one of your mansions because we need you to top up this fund. It's very interesting. And I think there are actually corporate members now. For many, many years, you had to be an individual to be a name, which is why it was called names, but not so.
Yeah.
Oh, but I mean, most of the...
Just think that the money comes from GIO, but it's not necessarily the case, is it?
No. The return on investment for Lloyd's names is pretty substantial.
Yeah.
But they accept that level of risk. It's like the original sort of unlimited liability shareholding is really what it is. Anyway, that's it from me.